All right, let's see if I can give you guys a little bit more clarity on the financial information that I'm looking for. And again, this is a finance class. I'm looking for, 2/3 or 3/5 maybe of your paper to be focused on financials. Okay. Quickly, too, let me add that I don't think I sent out a feedback to anybody that didn't have my concern that there was not enough financial information. Clearly, either I didn't express how important that was, didn't give you enough information, or simply you guys just haven't really started looking at your companies yet in terms of their financials. Maybe some combination of the three. You need to do that. Okay, between now and the end of the semester, you need to get into the financials. If you're confused, if you're not sure where you want to go, okay, the burden's on you. Okay, send me an email. Is this a concern? Is this what I should look at? Okay, I'm going to try to go through, and I will, a number of the companies. Maybe and take a look at some things, hopefully without writing your papers for you, right? But to give you an idea what I look for. Okay, now, is it okay to put the stuff in that I'm going to talk about? Yeah, might be more impressive if you find other stuff, that will be interesting. And what do I mean by that? Well, let's go take a look. The first one I chose, Under Armour. I know at least one of our folks has chosen Under Armour. I'm using the Morningstar site, and I think I've told you guys that's one of my favorites. You don't have to use Morningstar. Just go to your search engine, plug it in. Okay. Hopefully it'll bring it up. It brings up something that should look like this, and then you all know your ticker symbol because that was part of your assignment, right? And in this case, I have Under Armour, so put in my UA and it comes up like this, and I need to click on it. I could also have hit my enter button, and that would have got me to the same spot. And this is the first stuff that I see, okay? And I'm going to start my financial research just looking at this first page. I might get some interesting information on here that might take me in some directions, okay? Let's start scrolling down. First, opening price. I'm not terribly concerned about the price, okay? Price is what people are willing to pay for a company, and that may or may not have anything to do really with the financials of the company. There may be a whole lot of other stuff that impacts the price, and so I'm not too worried about that. I'm not too worried about the 52-week range, and I'm really not concerned about how Under Armour's price stands up against Nike. Absolutely no concern whatsoever about that. Okay, it doesn't belong in your paper. Okay, it does not belong in your paper. Market cap, on the other hand, maybe. Okay, maybe not. Okay, PE. We might talk a little bit about PE. This one's high. Okay, its price to earnings is quite high. The price to book is also fairly high for companies, and as compared to competitors, might be something you would take a look at. Okay, then this stuff, this is premium stuff that you'd have to be a premium member of Morningstar to get. Okay, you know what? Take a look at the chart. Again, I don't think that there's anything in here in particular that belongs in your report, but it might give you some idea how the company's doing. I clicked on the 5-year just to, heck, it's gone from $13, something like that, $17.85 it says there, up to now it's at $84, $85. It did hit a high of about 100 at one point in time, a little over 100 at one point in time. But again, that's probably not something that really belongs in the report. Okay, I'm not terribly interested as to what people are willing to pay for it. I'm more interested in the financials for this class. But let's come down here, and now we get some interesting information that does belong in your report. Okay, this does, yeah. Price to earnings. Look at that. The stock, that's trailing 12-month earnings, I'm guessing that is. 81.5 versus the industry average 24.1. So clearly people are willing to pay more than the industry average for this stock. Okay, the question that should be forming in your mind, that's okay to put that as one sentence in your report maybe, but the question that should be forming is why. Okay, the price to book 11.1 to the industry average of 4. Again, the question is, why are people willing to pay more for Under Armour? Okay, and the third one, price to sales, same thing. These things, price to whatever, right? They all kind of look at the same thing, and what it's telling you is that people are willing to pay a lot more for Under Armour than they are for other companies in the industry. And your question should be why. Okay, and that's the question that you want to ask, and that's the question that you want to answer, part of the question or part of the things you want to answer for your report. Okay, and let's just keep going. Well, now you had 3 red ones there, and now you got 2 big long green ones. Revenue growth, 29.3%. That's 3-year average annual revenue growth versus an industry average of 8.7%. Do you think that might be one of the reasons people are willing to pay more for Under Armour? Income growth, net income growth, 21.8% versus an industry average of 6.6%. Do you think? Okay. And so we've already formulated some basics there. This is a company that's growing faster than the industry as a whole. It's gaining some market share, right? Okay, those are the things you want to take a look at. As we come down here, we'll see more precise numbers as to why that is, right? We've seen revenue that's gone from 2.3 billion to almost 4 billion. Income, okay, things like that are going to be important to add, okay, and you should include those. Now, here's what I want is this discussion that's up here about this. And I want these numbers to be the supporting numbers for that, okay? If your report is all about the supporting numbers and not about the discussion, I'm going to have some problems with that. And what do I mean by that? Well, if you start your financial section with, revenue grew from 2.3 billion to 3.9 billion, and operating income grew from from 265 million to 409 million, and net income went from 162 million, it's boring. Okay, is boring, and it doesn't really tell me, okay, why, okay, how does it compare, okay, those types of questions are the questions that need to be answered. We could take a look at our balance sheet. In this case, probably one of the big things, we've got both a growth in total assets and quite a bit of growth in liabilities, so they're obviously using some debt, to finance this growth. On the other hand, its debt to equity ratio was actually below or better than the industry average. So its debt to equity ratio is clearly not out of hand, but they're having to borrow some money. Okay. Here's one that pops out, and these are the things that I really want you to look for. Okay. These are the things that to me are interesting, and you come down and you look at the cash flow and you go, let's see. So in 2013, its cash flow from operations was 120 million. In 2014, it was 219 million, and then all of a sudden it dropped to minus 44 million. Ooh, what happened? Okay, I think I want to know. Okay, cash flow capital expenditures. Now this one's not so surprising, but it's certainly worth looking at. So capital expenditures have had a negative impact on its cash flow to the tune of 88 million, 141 million, 299 million. That's a little bit more consistent in the right direction, though, right? That what's that saying? It's saying that the company's obviously spending a lot of money on capital improvements. Okay, they're building warehouses, they're building transportation systems, they're building those types of things, right? Buying equipment to make clothes, whatever the case may be. That might be something you want to talk about. Free cash flow overall is kind of a combination of those two then, right? And again, we see a big drop. This one's an impressive drop, for a company that's awesome, right? That's doing awesome. Their operating income's gone from 265 to 409, and from 354 to 409, right? And all of a sudden they had a drop in cash from operations. Wow. Well, how do I, where do I go to look, and how do I figure that out? What the hell happened? Well, let's go look at financials. Okay. Now, I'm looking at raw data here, and I'm making a lot of assumptions. You would be mistaken to write your paper in that same fashion, that you want to look at this same data that I'm looking at and showing you, but then you need to dig out the annual report and see what the management says about that. Okay, and that's kind of the stuff that I'm kind of interested in hearing about in your report is, how did management address that, or did they? Okay, and that's going to take reading the annual report. It may be that the change was from 2013 to 2014, in which case you'd need the 2014 annual report. Okay, that's why you might need more annual reports than just the most recent. Okay, but this is such a great starting point, and Morningstar has great, gives us a great amount of data here that we can use as our starting point before we look this stuff up, right? Okay, so let's take a look here at cash flow then, because those were the things that were of concern, right, that I had on the prior deal. So let's take a look here. So I clicked on cash flow under the financials. I could look at the income statement, the balance sheet, and I want to look at those for sure. I'm doing some shortcuts, here, because I just want you guys to see, when I catch something like that, I got to see what's happened, right? Okay, so net income's been, by the way, they switched directions on us here, and I could change it the other way too, but anyhow, they switched directions on us, and so I got net income from 2011 to 2015. That certainly isn't why my cash flow went down, right? Depreciation and amortization, that's actually helped the cash flow, is what that's saying, right? Because I've had more depreciation than I had back in, right? Stock-based compensation's been a plus actually to cash flow, meaning that they've paid people with stock instead of money, but no big deal. But here's where it gets kind of interesting, right? Okay, so the company's accounts receivable jumped, and they've jumped, actually 34, 53, 36, no big deal. Took a pretty good jump in 2014, and then an even bigger jump here in 2015. Part of that is simply because they're selling more. Their sales have gone up a lot, and that may be the reason that their accounts receivable. But I might ask the question about an aging of their accounts receivable. It might make me a little nervous, and I might want to look at that if I'm looking at Under Armour and saying, has their average payment that's coming back to Under Armour gone from 30 days to 39 days? Is that something that's a concern to management? Has management purposely extended terms in order to push inventory out the door? That's a possibility as well, right? And so finding the answers to that question, sweet, okay, that would be awesome. Inventory, what happened here? Well, gosh, so we had, when it's a negative on the cash flow, that means that we had an increase in inventory. Okay, so when it's a negative on the cash flow, we had an increase in inventory, right? Because we had to make the inventory, buy the inventory, whatever the case may be. And so we had to expend cash, and we've got inventory then sitting in our shops, right? And so it was 115 million here down to 5 million here. So we had a huge improvement in inventory there. Big years, and then inventory built. That's probably not unexpected after a year like that. Then it actually had kind of an improvement, right? But look at that. Okay, so what happened here in 2015? We went from 85 to 279 million in inventory. I'm kind of interested in knowing. Okay, I really am. I'm kind of interested in knowing what happened there. Did they build inventory purposely? Was it because of, and what I heard a lot during the year about Under Armour was that it might have been weather related? Did sales slow some, or slow at least below expectations? Because we already know, right, that the sales were pretty good. I mean, they increased quite a bit in 2015, but were they less than expectations, maybe because of weather or something like that, and that caused a huge build in inventory? It's possible. Prepaid expenses, also a pretty big build in prepaid expenses, and this one's kind of interesting too. You might want to look at that. That may be a decision made again by management to try to prepay some things purposely, Okay, what types of prepaid expenses might you have? You could prepay taxes. You could prepay, some other items. Wages even and whatnot. Okay, there are different things like that you can do in an accounting sense, and so you might take a look and see what they've done there. That's a pretty steady growth, and so that might just simply be a growth that's associated with the growth in their sales. Okay, but accounts payable, this is kind of interesting. So this kind of means when you had a positive that they were using their accounts payable and delaying payment. And that's a pretty big change to go from a 49 million plus to a minus 23. So you might want to take a look at that. Again, it may be they may have purposely prepaid a bunch of stuff, and they may be doing that for tax reasons. Very possible. Okay, so take a look. Okay, and then we've got, remember also we had that huge change in the capital expenditures, and we got to know what that is, right? Well, here we go, investments in property, and this is really the number, right? These ones weren't reported necessarily on the cash flow or on that front page. Okay, but you might take a look at these now that I hadn't looked at this earlier. This is kind of cool. Okay, so investments in property, right? Ooh. And that went from 141,299,000, so a huge. Acquisitions net, look at that. Okay, again, that wasn't on the front page, but boy, so I jumped net cash used for investments. This 103 is purchase of investments. That could be government bonds, whatever the case may be. It's just accumulating too much cash. 103 except sales or maturities of investments. So here's the deal with these two. They kind of net out, don't they? Right? They made purchases of some investments. These are likely bonds or whatnot. Could be government bonds. Sales, maturities. That's kind of a net of almost nothing there. Okay, and this one doesn't amount to anything. But it'd be kind of cool now. I'd kind of like to know what those acquisitions are. Okay, so I hope that it's coming across a little bit. Like, we know that they've increased debt, and there's debt issuance there, other financing activities, net change in cash. We saw that. That's because of this, right? Because some of the negatives that were up here. So we had a big net change in cash or a decrease in cash. That's to be expected. The free cash flow is hugely negative, but that's for reasons, right? For reasons that we show up above there that I'm kind of interested in knowing. Okay, so each company is going to take you in a different direction. I've looked at Under Armour here, and I'm going to quit pretty soon because I want to keep these relatively short. But each company may take you in different directions. It may be the cash flow, it may be the balance sheet. I saw some things of interest in Under Armour. Okay, I didn't look at Under Armour's balance sheet. Okay, I would guess that some of those things would be confirmation of what we saw. There, look at that. Nice increases in current assets. This is a little bit more steady and not a ton of information here jumps out at me just looking at it, although they had a big increase in current or in total liabilities. Okay, because they issued some long-term debt. We saw that, right? Nothing here that jumps out at me in particular, but that doesn't mean that you shouldn't look at it. And that doesn't mean that you shouldn't comment on it, because look at that. What a nice trend in balance sheet. And if we come down here, stockholders' equity, that would be one of the more important things. It's doubled, right? That's double in more than double, a little more than doubled in, a few short years. And actually, oops, I'm looking at the wrong one, 2015. So from 2011 to 2015, look at that, it's gone from there to there, 2.5 times. Okay, that's impressive. That's impressive. Again, that's why, when you go back to that quote and you wonder why Under Armour's price is so crazy. Hang on here, it's not wanting to work for me. It doesn't want to come up. We'll see if it does. It the renewal. Sorry about that little bit of a wait. I apologize for the computer. Well, quote overview. Huh. There we go. Okay, it's why people are willing to pay more, right? Okay, we looked at some of those things in terms of the growth in equity, the growth in sales, the growth in net income, on and on and on. That's why people are willing to pay more, okay? And, might help you make your decision, okay? Over here under competitors, I want to hit this really quickly because you're going to find for each company, maybe some good information here, but also a little bit misleading. If I were to ask you guys who's the main competitor for Under Armour, I think your answer would be Nike. That'd be my answer, right? Okay, and some of these things, then when I click on that, it brings up a good full page. Make no sense to me, right? VF Corp here makes a lot of sense. VF Corp, by the way, is North Face. Okay, so North Face is a good one. It's a good comparison, right? It's a little bit bigger company, net income, a little nicer. Look at that, but not selling for as much, so my guess is growth rates probably haven't been all that great. Nice dividend for North Face versus Under Armour. Okay, foreign companies here, you might click on those. I'm not familiar with it. Hanes Brands, we're all familiar kind of with Hanes Brands, but that's underwear, right? Underwear is mostly, they sell some other things, sure. Michael Kors is, that's a retailer. Ralph Lauren doesn't compete. Guild and Activewear I'm not familiar with, so a person might click on that and see what it is. Carter's, I don't know. I come down here though and I find one that's kind of a direct competitor. It's Columbia Sportswear. And interesting, Columbia's a nice old company too. A little more I don't know what you'd want to call it. It's been around longer, has more stable, maybe. It's not growing as rapidly, those types of things. But I don't see Nike on here, okay? And so, use some common sense when you're looking at this list of competitors and say, Nike's not on here and it ought to be, okay? And so then you might have to just go look up Nike yourself. And Nike's a company that a lot of others have chosen that they're going to do their report on, and so I may address that as well. Morningstar rating too. My guess is the reason the rating is there, and they won't maybe necessarily tell us a bunch unless we get the premium, is simply because it's priced quite a bit higher than competitors. Okay, people are willing to pay more because of the growth and whatnot, but it is priced quite a bit higher than competitors at this point in time. So, okay. So again, I don't want to make these too long. That's longer than I wanted to go, but hopefully this gives you some more information. Please maybe watch these even if this is not your company, because I'm going to be doing several more of these in the future, because hopefully it will give you ideas of things to look for with your own company. Thanks. Have a good day. It's actually National Beer Day today, so celebrate safely.